How to invest during a recession safely and smart. Have you ever wondered how some people get richer during a recession while everyone else seems to panic and lose money? It almost feels unfair, right? The markets crash, businesses struggle, people lose jobs. Yet somehow, the wealthy manage to walk away with even more wealth than before. But here's the truth that very few people talk about. Recessions aren't just financial disasters, they're hidden opportunities. The problem is, most people let fear control their decisions instead of using strategy. So, in today's video, we're breaking it all down. I'm going to show you exactly how to invest safely and smartly during a recession, so you can protect your money, build long-term wealth, and even come out of tough times stronger than before. By the end of this video, you'll know what actually happens to the economy and markets during a recession, how to build a strong financial foundation before investing, the smartest investments to focus on, and how to think like a millionaire when everyone else is panicking. Let's get started. 1. What really happens during a recession and why it's not the end of the world. Let's start with the basics. A recession simply means the economy is shrinking for an extended period. Businesses are earning less, unemployment rises, and people spend less money. It's a slowdown, not an apocalypse. But when people hear recession, they imagine chaos, stocks falling, layoffs, housing prices dropping, and yes, those things happen. But here's what's fascinating. Historically, every recession has eventually been followed by a period of massive recovery. Let's take a quick look at history. In 2008, the S&P 500 dropped over 50% during the financial crisis. It was brutal, but by 2013, it had completely recovered, and by 2020, it had tripled. In 2020, during the COVID crash, markets dropped nearly 35% in a matter of weeks. But investors who stayed calm and kept buying saw record gains just months later. The point is, the market always moves in cycles. There are ups and downs, but it always trends upward in the long run. So instead of fearing recessions, you can think of them as temporary sales on valuable assets. When everyone else is scared and selling, prices fall, and that's when opportunities appear. The key is to avoid panic and focus on logic. Because panic sells, logic buys. 2. Strengthen your financial foundation before investing. Now, before you even start thinking about investing, you need to make sure your financial base is strong. Think of it like this. If the economy is a storm, your foundation is your shelter. If you're standing on shaky ground, meaning you have debt, no savings, or inconsistent income, that storm can knock you down fast. So let's build that foundation. Step 1. Create an emergency fund. Before buying a single stock or crypto coin, make sure you have 3 to 6 months of living expenses saved in cash or a high-yield savings account. This is your financial cushion. It protects you if you lose your job or face unexpected expenses. Because if you don't have this buffer and something goes wrong, you'll be forced to sell your investments, usually at the worst possible time. Think of your emergency fund as your safety net. It keeps you calm and confident when others are panicking. Step 2. Eliminate high-interest debt. You can't grow wealth while paying 20% interest on credit card debt. That's like trying to fill a bucket full of holes. Start by paying off those high-interest debts first. Credit cards, payday loans, or anything above 10%. Once you're debt-free, you'll have more cash flow to invest during the downturn. Step 3. Budget and cut unnecessary expenses. During a recession, cash flow is everything. Reevaluate your expenses. Are there subscriptions you never use? Meals out that can be replaced by home cooking? Every dollar you save can be redirected toward investments or your emergency fund. It's not about deprivation, it's about preparation. By creating a solid financial base, you're setting yourself up to invest confidently without fear of what-ifs. And that brings us to the exciting part. Actually investing during a recession. Hi. Over time, your average cost per share decreases, And when the market recovers, your returns grow faster. Consider index funds or ETFs. If picking individual stocks feels overwhelming, you can still invest smartly with index funds or exchange-traded funds, ETFs. These funds let you invest in hundreds of companies at once, spreading your risk automatically. For example, the S&P 500 Index Fund includes 500 of the largest U.S. companies. If one company struggles, it's balanced by others that perform better. Even Warren Buffett, one of the greatest investors ever, has said that most people should just invest consistently in index funds. It's simple, it's low cost, and it works. If you're enjoying this video and finding it helpful so far, make sure to hit that like button. It really helps the channel grow, and it lets me know you want more content like this on building wealth and financial freedom. Diversify your investments. Now, while stocks and index funds are great, they're not the only way to invest during a recession. Smart investors diversify, meaning they spread their money across different asset types so that if one market dips, others can balance it out. Let's talk about a few key options. Real estate. During recessions, property values often drop. Sellers become more flexible, and mortgage rates might even go down. This is a golden opportunity if you have cash and a long-term mindset. Imagine buying a solid property when prices are 20% lower, renting it out, and watching both your equity and rent income grow as the market recovers. But here's a warning. Don't over-leverage yourself. Always make sure your rental property can cover its own costs, even if rents dip a little. Real estate isn't just about appreciation. It's about cash flow and stability. Bonds and treasury bills. If you're risk-averse or nearing retirement, bonds and treasury bills are your friends during recessions. They provide steady, predictable returns and can protect your portfolio from volatility. You won't get rich overnight with bonds, but they'll keep your money safe and growing slowly while stocks ride out their ups and downs. Commodities and gold. Some investors also like to hold small portions of their portfolio in commodities like gold or silver during recessions. These often hold value when currencies and stocks fall. It's not mandatory, but a little diversification can add an extra layer of protection. Yourself and your skills. This one's overlooked but incredibly powerful. Investing in yourself during a recession, learning new skills, starting a side hustle, or upgrading your education can lead to massive financial gains later. Because here's something most people miss. The greatest asset you'll ever own isn't a stock or a property. It's your ability to earn money. Every skill you gain increases your earning potential. Whether it's learning digital marketing, coding, real estate investing, or freelancing, recessions are the perfect time to sharpen your edge. 5. Manage risk, like the pros do. Now, investing during a recession doesn't mean taking wild bets. It's about protecting your capital first and then growing it. Let's talk about a few ways to manage risk the smart way. Stay liquid. Always keep a portion of your investments in cash or liquid assets. That way, if an incredible opportunity comes up, like a great stock at a huge discount, you have the flexibility to jump on it. Cash gives you options, and options build wealth. Don't go all in at once. It's tempting to think, the market's down 20%, I should throw in everything. But remember, it can always go lower. Instead, invest gradually using that dollar-cost averaging strategy we talked about earlier. This keeps you invested without exposing you to too much short-term risk. Think in decades, not days. Most people lose money because they think short-term. They panic when the market drops 10%, sell, and miss the rebound. But successful investors, the ones who retire early and achieve financial freedom, think in decades. Ask yourself, will this company or investment still be strong 10 years from now? If the answer is yes, short-term dips don't matter. They're just noise. 6. The millionaire mindset during a recession. Here's something powerful. The way you think during a recession determines how you come out of it. When everyone else sees fear, millionaires see opportunity. Why? Because they understand that the best time to build wealth is when everyone else is too scared to act. Let's use a quick example. During the 2008 crash, Warren Buffett invested billions in companies like Goldman Sachs and General Electric when others were panicking. Everyone thought he was crazy. But a few years later, those investments generated billions in profits. That's not luck, that's mindset. Here's how to cultivate that same mindset yourself. Detach emotions from money. View market dips as temporary opportunities, not personal failures. Focus on what you can control. You can't control the economy, but you can control your spending, saving, and investing habits. Educate yourself continuously. Knowledge eliminates fear. The more you understand money, the less it controls you. And here's the truth. Recessions reveal who's prepared and who's not. The ones who've been building good financial habits, budgeting, saving, investing, will thrive. 7. The road to financial freedom. Putting it all together. So let's connect the dots. Here's your roadmap for investing during a recession. Step by step. Get your finances in order. Build that emergency fund. Pay off high-interest debt. Budget and track your expenses. Start investing consistently. Focus on strong, proven companies or index funds. Use dollar-cost averaging to smooth out your risk. Avoid speculation and emotional decisions. Diversify and balance your portfolio. Mix stocks, bonds, real estate, and possibly commodities. Keep a portion of cash ready for opportunities. Think long-term. Wealth builds over time, not overnight. Stay consistent, stay patient, and let compounding do the heavy lifting. Keep learning and improving yourself. Grow your income through side hustles or skill development. Recessions are temporary. Your knowledge is forever. Remember, recessions are a test of mindset, not just money. If you can stay calm, strategic, and consistent while others panic, you're already miles ahead of most investors. Conclusion. At the end of the day, investing during a recession doesn't have to be scary. It's simply about understanding the cycle, protecting your money, and making informed, disciplined decisions. Most people let fear guide them. They pull out of the market, stop investing, and wait for the right time. But the truth is, the right time is usually when it feels the hardest. Every market crash in history has eventually led to a recovery. And those who stayed invested are the ones who came out richer. So whether you're just starting out or you've been investing for years, remember, stay calm, stay consistent, and keep your eyes on the long game. And now I want to hear from you. What's your recession strategy? Are you investing, saving, or sitting on the sidelines? Drop a comment below. I'd love to see your thoughts. If you found this video helpful, make sure to hit the like button, subscribe, and share this with someone who needs to hear it. Thanks for watching Finance Compass, where we help you navigate money with confidence. Until next time, remember, your mindset is your greatest investment. Stay focused, stay smart, and keep moving closer to financial freedom.